Hi, my name is Vaibhav Porwal. I am a co-founder at Deserve. Over the last 6-7 days, markets have seen significant correction and many clients have reached out to us to understand what has triggered this correction, what will be the long-term impact of this correction, and how should they invest in the current market environment. Now, what has triggered this correction? There are two factors at play. First, the war between Israel and Hamas. Though it's an age-old conflict, but this is the first time we are seeing a risk of it escalating beyond the boundaries of Israel and Hamas. Having said that, if it remains contained, then we don't see significant risk to the global economy. Second factor, which is impacting the global economy, is the changes in the interest rates. Interest rates have remained high for a long period of time. In fact, for the first time in 16 years, the US rates have gone beyond 5% levels. And it will have significant ramifications both for the global markets as well as for the Indian market. So these are the two factors which have contributed to significant correction in the markets, and this correction is not just limited to Indian markets, it's a widespread phenomena. All the global markets have seen this correction. Let's discuss the impact of these events on the markets and for the investors, both short term as well as long term. In the long term, the economic fundamentals matter the most. And I don't think there will be a meaningful impact on economic fundamentals of this war. We have seen that in the past also. Russia and Ukraine has been going through a war situation for last 18 months without any meaningful impact on the global economy. Similarly, in the case of Israel and Hamas also, as long as the war remains contained and remain localized, I don't see meaningful impact on the global economy. Having said that, if there is any escalation, and the war spreads out to other parts of the world also, we need to reevaluate our investment strategy. Second impact could be on sentiment, which is more short-termish in nature. Short term, we have seen that people are taking a guarded approach and moving some money away from equity into safe assets like gold and fixed income. That for short term is a good option. But for long term, investors need to reevaluate their asset allocation and go back to that. So what should investors do now? Investors have money both for short term as well as for long term. Short term, because interest rates are high, it's a great time to lock in your money in fixed income instruments. You can generate very attractive returns by investing in corporate bonds both in India as well as globally. For long terms, let's look at the fundamentals first. Fundamentals can be divided in two parts: economic fundamentals and market fundamentals. We'll start with economic fundamentals. India remains the only large economy which continues to grow at 6% plus rate, which means we have a great wealth creation opportunity ahead of us. If we invest in growth assets like equity, we will generate significantly higher returns. In terms of market fundamentals, market valuations, because of this correction, has come below the average at which we have traded for last 10 years. The average PE ratio of the market for last 10 years is 21. Now we are trading at 20.5, so which presents a significant opportunity for investors to create wealth. On the other parameters like corporate earning growth and corporate balance sheets are healthiest that they have been in the last 2 decades. Debt to equity for all the corporate balance sheets have gone down below 1:1. On the earning momentum side, we are growing at 15 to 17% on an year-on-year basis. So all these fundamental variables are really important to take into consideration before deciding to invest. In our view, there is a great opportunity both in fixed income as well as in equity to capitalize on.